we do an hour, 10 minutes. I just feel like it races by.
It does.
Right? I mean, when I'm with my trainer, 1 minute takes so long. I mean, the guy's like killing me, but an hour in here flies by.
Love
right?
it.
You know what I mean?
What I thought you were going to say is that, yes, I do know exactly what you mean, but I thought you were going to say between appearances, because the last time you were on,
yeah,
I think it was November.
Buy the election, sell the inauguration.
It felt like yesterday.
The title, I looked at it and I thought, okay, at least that aged well, because we told people buy the election, sell the inauguration, and that worked perfectly. Yeah, that aged pretty well. Because sometimes you say stuff that doesn't age so well.
All right, so this is what Sean went back and said the top takeaways. Prediction markets beats polls. Yep. Gross margins matter the most. We're going to talk about that again today. Sentiment is a risk.
Am I supposed to look at you and smile?
No, you just.
I'm not particular. All right.
So you said sentiment is a risk, with nearly everyone bullish and no wall of worry left. Overly optimistic. That was a good call.
Yeah.
And then AI-driven margin expansion ahead.
Yeah.
And then lastly, valuation only hurts when companies miss.
We wrote a big note about valuation this last week, and Josh mentioned he wanted to talk about that. That's cool.
Yeah.
I've gotten a lot of feedback.
Were you afraid to hit publish?
No, not
really. Even a little.
No. You know, there are like I did get some incoming. I got one old school value PM at a long way firm who asked me to unsubscribe because he said he doesn't like being insulted. And I'm like, look, I didn't mean to insult you. I don't know what you mean. And then he like unwound it.
But you know what? This is not new, right? You've been saying.
Put these on, right?
You've been saying something like this.
Slide this way. Gotcha.
We've been having this conversation for a decade.
Yeah, we know we can't buy super cheap stocks, right? Here, let me. Is there a right and a left?
Yeah, it's on the inside.
Yeah, the wire comes down the left.
Yeah, the wire.
All right.
goes across your chest.
Toward the end of the show, we're going to get a print from Amazon
Right.
and Apple.
I know.
Jesus.
I know.
Adam was paying us a compliment before you walked in. He said, it's unbelievable how fast these episodes go.
I was saying,
in the studio.
I was saying it's really, time flies when you're having fun. And I was saying, I don't know if this happened to you, but you go to your trainer and like, he's like, you got 90 seconds and like a wall sit. And that 90 seconds seems like 2 hours.
It goes by forever.
Right. And this hour flies by because it's so fun to see you guys.
Are you working out with a trainer right now?
No, I try to work out every day. I just also eat too much. You know how that is. But
oh, really?
Yeah.
I don't know anything about that. I'm taking golf lessons this summer.
Nice.
I started in April, and I can actually. I played golf when I was younger. I stopped to raise my kids for like 18 years.
Right.
And then this summer I said, you know what? My kids are big. Nobody needs me on the weekends. I should pick it back up.
Right.
So rather than screw around for no reason by myself, which I did last summer, this summer I said, I'm going to get lessons. And it's amazing. You forget how good it feels when you're terrible at something, but you keep trying and you like improve. Because I'm already the best in the world at what I do for a living. So like this is an endeavor where I'm the worst. I was waiting for the No, but this is something I'm really bad at. And I'm still really bad at it, but I'm not as bad as I was when I started. And that feels really good.
It's a good feeling when you hit one like high and sort of straight and toward the green.
Or just
While
like
it's in the air.
Or just like you don't expect to do well.
Right.
It's like, all right, this week we're going to work on chipping onto the green. And I'm like, oh, here we go. And then like you can actually do it. And it's like, holy shit, I could do this. It's a really good feeling. I forgot about it. Because I haven't really challenged myself in a long time. So
I think you are great at what you do, by the way. I didn't.
What do I even do?
I didn't need to correct that. I think this is.
I'm not even sure what I do. So I'm really, I appreciate you saying that.
I'm not like a, I feel like when people meet me, they think that I'm going to have that like sense of humor where I like to like make fun of. I'm more like a lover. When people ask me to speak at stuff, I don't like doing the whole like insult thing. I like to do like the compliment
Positive
thing.
vibes.
Yeah. I like people. I like people.
I was saying to Josh and Ben earlier, can you recall a stock in the Dow that is crashing? Talking about United Health, it's down 60% while the index is at or near an all-time high. That's got to be rare, right?
I think Intel, while it was a Dow component, looked that way. Maybe not as fast, but as damaging. Yeah.
But
I can't think of a lot.
The speed of the decline, you know what I mean? Like it's GE was crashing.
Maybe I'll say maybe Boeing.
I looked at Boeing. Okay. So Boeing was falling, and then 2020 happened.
It's rare. To your point,
no, it's totally unusual. Because usually, by definition, to be that big, you're like a barometer for some sub-industry, right?
I think as a Dow 30 stock, it's more likely that you'll have a gradual decline, a la IBM, for 15 years.
Right. like a melting ice cube. Not
Yeah.
Usually it's because debt and arrogance cause massive declines, and like this one doesn't have a debt issue.
What's the story with United? I don't even know what the story
Look,
is.
if you
They're
plot,
making too much money.
if you plot, look, I complain about them all the time because I run a small business and we use United Health, and United Health, if you're married with kids, it's around $4,000 a month for their plan. And they raise it at an average of low double digits per year. So, it's going to be $4,500 a month next year. Well, when you run a small business and you have 9 employees and you add all that up, it's a row in our P&L as the healthcare. And as you guys know, you don't get a lot for that service. So, but I'd say backing up is plot like drug stocks the last 30 years, Pfizer or whatever. It's kind of hunch, right? We all have good buddies, I assume, that are like general practitioner doctors. And honestly, like it's really disappointing, but they're kind of middle class. What's really captured all of the money in the system is UNH is up 10,000% as a stock in the last 30 years.
It's so funny you say that. Yeah. It's so funny you say that. Like when we were growing up, like the most like honorable thing in the world in like a Jewish family in the suburbs in New York, I'm going to grow up to be a doctor.
Right.
This is like,
it still is honorable. It just unfortunately doesn't, in some aspects of the profession, just doesn't get paid what you feel like it should, given the education and the effort it costs.
This is XLV divided by SPY. It's at the lowest level since 2001.
Right.
It's just crashing.
Yeah. I think UNH is interesting, just to finish in that one question, is just, look, I have a buddy who's like a accounting-based short guy. He's a total like ninja. And he told me, I've been trying for 20 years to actually understand how they make money. And it's like every time I get down like a hallway, they like close the light off and tell me to redirect. So I think it's getting a light shined on it for some awful reasons. The CEO was killed, some other stuff. And I think people are sort of saying, oh, this is a value stock and it could double. And I'm just not so sure. I don't really know.
Well, that's the answer to the question.
There's a lot of uncertainty.
They make too much money relative to what the average household can afford to pay.
Yeah.
And the amount of denials of claims is the reason why they've made too much money.
Right. It's hard to get.
They don't deny everything, but they deny too much.
I'm sure
to preserve the
I'm
profit
sure you
margin.
know this. Probably some of your viewers know this, but there's a whole cottage industry born out of this where, idiots like me can say, you know what, I can't figure out how to get down getting those payments, and you can pay a service to capture some of it for you and just give that person a percent. So I say, hey, yo, we owe 10 grand in various things for, my wife and my kids and me. And like, and they'll battle for you. And it turns out that a lot of the way you get your money back is you just have to keep going.
So
take no for an answer. And then that person takes 15% or whatever she takes. And you're like, all right, I'll take my 500 back, give her 1,500. That's better than me not having 10 grand. And that's just how hard it is. You need to actually hire people to berate them.
So
it's
our
a tough
health
industry.
insurance comes through the PEO. Yeah. And that's their Trojan horse. They offer you a teaser rate for your firm.
Right.
And you say yes, and then they boil you slowly like a frog. And then it comes time for renewal, and all these other PEO.
How does 17% increase sound?
Right. So all the PEO providers, they're like, looks like you're up for renewal next year. Yeah. And then they offer you a teaser rate. But we learned, like, it's always fake. It's going to eventually it's going in one direction.
And we have only 9 employees at Trivariate, and then we had a bunch of like outsourced relationships. And like, it really helps if you have scale. Like once you get to 50 employees, you can really lower it. So yeah, I don't know what's going to happen, but I'm not that tempted to think it's a great value there. And look, if there's a recession, obviously small and medium business go out of business, whatever. But like everyone else, I'm going to be a Florida resident, next year and move my business there. My kids we're empty nesters now, and so
Congratulations.
and thanks. And I travel all over anyway, so it's not that hard to spend 200 days outside of New York, and the prices are more reasonable for insurance and health insurance in Florida.
You're going to have to move your business.
Yeah.
Like the paperwork is going to have to say Florida.
That's right.
Because they don't want to hear about 6 months in a day anymore. New York State now wants to know, but where do you get paid from?
That's true. And it's a very complicated process. You have apps that track the cell tower where you are all day. You have to report. There's
too many people.
New York is incredibly diligent at like that one thing, which is going after people for taxes. Nearly everything else, they're an abomination. I would say. So,
yeah. What do you think Hulk Hogan's net worth was when he died?
I have no idea.
Take a guess.
13 million.
I'll take the over. I think there's been a lot of stuff.
This is one of the one of the most famous people in the world.
I'll take the way you set that up. It's probably lower than he's guessing, but I feel like he's gotten a lot of. And I wonder how they count net worth. Is that like everything, like the
I'm picturing
houses,
Zach Galifianakis.
Yeah, for
meme
God's
with
sake,
the-
just give me
with
the damn number.
With the calculations running past your face, with the formulas.
I think the other thing is people got paid less back when he really ascended, right?
That's a good point.
Yeah. What'd you say, 13?
Yeah.
Can we go prices right rules? I'll just take the over.
Okay, over.
I'll take over 13.
Double that?
13
Triple
million,
that?
13 million one. I'll take 40 million.
Okay, you're close. 25 million. That was very surprising to me. Died at 71.
Wait, which part? That it was that
Only
high or that
25
low?
million. This is one of the most famous people in the world.
I think that, it's like what
I think if you showed a picture of him to people on every continent, more people would know him than would know Joe Biden.
probably more Americans. You don't need every continent.
I think he's one of the, maybe famous is the wrong word, most recognizable characters in the history of America.
One of my best friends was a head women's tennis coach at the University of Florida for like 25 years.
Slept with Hulk Hogan?
No, I'll try to make the bridge. This could be a bridge too far. But he tried to convince the players not to turn pro. And the way he did is he showed them like earnings from that career. And I went back and looked at like 80s and 90s when Hulk Hogan was, and like Navratilova or whatever, she won like 9 Wimbledons. Like her career earnings are so much less than yours.
Yeah.
I mean, it's like, so I just didn't pay that much during maybe his ascent, maybe.
Yeah, I think that's definitely part of it. Also had a bad divorce.
Also divided by
no
2.
prenup.
But 25 seems high. Like to Adam's point, he wasn't making that much in the 80s wrestling. I'm sure he's making fine money, but where did all that come from?
So,
movies and other stuff. And,
so like
Endorsements,
I would
whatever.
bet half of his net worth was earned in the last 5 or 10 years with licensing stuff.
Right.
So he died 71. It's under Florida's spousal elective share statute. The surviving spouse, he has a new wife, is entitled to a minimum of 30% of the deceased estate, even if the will was not updated after they got married. So a third is going right to the new wife.
So that's 8.
Then there's
that's
the ex-wife.
That's 8.8.
2 ex-wives and an estranged daughter. He left behind an $11.5 million mansion in Clearwater, Florida. So if you're moving down there, you might want to look at the Hulk mansion.
Yeah. Is that not part of the 25?
It's
I assume it
gotta
is.
be. Yeah.
I assume it is. This is crazy. So
By the way,
here's
that's
the
now
point.
worth 9.6 because the people that's worth less because the people who got the
It's like
get
the
money are
Grace,
gonna
but
sell it.
that could be, you could position that property as like the Graceland of professional wrestling.
But didn't like Michael Jordan's house stay empty for like 15 years in Chicago? I don't know what that's
That was
worth.
in the market
If
for
there's,
it.
if there's
Nobody
if there's
could buy
whole
it.
crap all over it, people might not want it.
According to Trust and Will's 2024 probate study, this is crazy, only 2% of American adults realize that probate would take 20 months, which is the average time needed for the process to run its course. 56%, majority, are totally in the dark about the associated costs. 10% expected would cost less than $1,000. Only 4% of the survey participants are prepared for the probate process to cost more than 10 grand. So a lot of people are just not prepared for this kind of thing at all.
This is a big thing. I mean, we're all over the place. But this is a big thing with the NIL money. These college kids are getting where they actually don't realize they have to pay taxes on it.
Yeah. So don't tell them that until next year.
Right. So then April comes around and they got $400 grand for being a third string offensive tackle. And April comes around and, they owe 170. They don't have it.
He won a $140 million judgment against Gawker Media.
Oh.
In 2016, Gawker Media
right.
is a website, a gossip website. They published a sex tape of him with his friend's wife.
And Peter Thiel backed that case. That was
And then
huge.
Peter Thiel, like secretly, and then he came out and said, I did this, backed Hulk Hogan's lawsuit, and they won.
And he put them out of business.
Oh, yeah.
Yeah, I remember that.
I
forgot that.
don't know that we need the media to be doing stuff like that. All right, we ready for the show? There's a lot of adjustments being made. I like that. A lot of preparation.
I didn't know we hadn't started.
That's coming in.
0% chance. 0%
Welcome,
chance.
friends. Episode 202.
Today's episode is brought to you by Global X ETFs. Navigating today's markets can be complex, but that's where Global X steps in.
They offer ETFs designed to help investors access a broad range of asset classes and investment themes from the AI ecosystem and defense tech to income strategies that are built to perform across varying market conditions.
That's right, Josh. With over 15 years of experience as an asset manager, Global X is here to meet your investment needs. Curious about how Global X offers investors a portfolio of possibilities?
Visit globalxetfs.com and start exploring new opportunities today. Holy shit, episode 202. Ladies and gentlemen, you are now rocking with the #1 investing podcast in the world. I only have that data because John told me that. Do I have that right? All right. Nicole's dancing in the studio. A lot of enthusiasm. Duncan is here.
Welcome back, Duncan.
Yeah.
Were you here last week? Oh, well, good to see you again.
We have a special guest in the studio, my friend Max Frank, who's helping us out with a special research project this summer. You having fun? Yeah? Best special project ever? All right.
I wish I looked like him.
Yeah, well, this kid is he's living the life. Binghamton? You know Binghamton? Okay. And this summer, working on the docks, filling up boats and jet skis with gas. Could there be anything better?
Do I want to be taller or thinner?
Work
more
outdoors.
handsome and be outside? Okay. Yeah. It's called a crowded long.
Yeah, no doubt. All right. Max, welcome to the studio. All right. Let's start with the Federal Reserve. So we had a kind of non-event FOMC this week, but not really a non-event because I think the narrative coming from the Fed has now gone to a new place. So this is my take on what happened yesterday. Obviously, no cut, but what he said put the September cut, which we thought was a done deal, in doubt. The Fed is now using this term efficiency. They don't want to make too many adjustments. They want to be efficient with the adjustments they do make, which sounds a lot like higher for longer, but they would not say that phrase higher for longer any longer because that'll piss off the White House. So immediately, we have a chart on this. Immediately, the Fed funds odds changed. And I think, I didn't look at it today, but immediately what happened was they went to like 45% odds for September cut, which I think was down from 80-something% odds. And the efficient Fed monetary policy is now the new higher for longer. What are your thoughts?
First of all, congrats on having the #1 show.
Yeah.
It's amazing.
Well, you make that possible.
We also have the best cup of coffee in the kitchen.
No, I'm serious. Like, let's just face it. Like, you're competitive people, and when they rank stuff, who does #1's good, and everything else is not as good.
Agree.
So
totally
congrats.
agree.
I'm just, somebody just asked me to smell the roses out there, and I did.
Yeah.
And so I'm bringing that in here.
Love that.
The second thing is,
bring his mic up.
Of all the things that are hard to do, and I'm not saying I can do it, but I think interest rates is really, really high up the list.
Hard to decide where the
hard to
rate.
forecast the 10-year yield 6 months out. Hard to forecast the front end. There's a function on Bloomberg that most of us have access to, WIRP, right? It's like what people think rates are going to be, probabilities of rates, and it's really funny that we're talking about this right out of the gate because I'm moving my office to 6 floors higher tomorrow. In fact, I'm running out of here to get the first stuff moved out a little later today. And I was digging through the file cabinet and I saw something I published as a strategist in 2010. I'd done a detailed survey of institutional investors asking when they thought the Fed would cut rates, and by far and away the highest probability raised rates. The highest probability was 6 months later. People thought, and it turned out to be expo 6 years later.
Yeah, they never raised rates
people
again.
have a very poor algo for forecasting what the Fed's going to do. They're consistently wrong. I worked at Morgan Stanley for 7 years. The interest rate strategists were wrong all 7 years in a row about what was going to happen. Again, I'm not saying I can do it. I'm just saying these people are paid for a living. They're really smart. They have access to the Treasury, the Fed, really smart people, and they get it wrong. So the idea that like any of us have any clue, I don't know. What I thought I learned through the years is they pay attention to full employment and stable pricing. And if you look at that, I'm not sure they need to cut rates, right? Obviously, you mentioned the key point, which is the president is been clear that he would like lower rates, and so that
the economy is too strong to have rates this high.
It feels to me.
Say, wait, what?
It feels incongruous.
That's what he says.
Right. It feels incongruous. I'm with you, and also like I'm not 100% sure that if you're bullish on equities, you want them to cut a lot. Like, think about the sequence of how we get data, right? We get the price action, and you and I talk about the 4 prices lead everything, right? Certainly the economy. Then all of us are getting better and better at sweeping new data points, whether it's on X or LinkedIn, or we look at natural language processing, every earnings call, transcript, whatever. Then the companies report earnings. Then the economists do whatever they do, and then the Fed acts. It's like by the time the Fed tells you something, it's already way after so many things have happened.
By
So
design. That's the data dependent
totally.
part.
So like people are like, it's lagged. I'm like, yeah, no kidding, it's lagged. So I look at it and I think to myself, well, what was the best call you could have made December 22, cover your massive NVIDIA and Meta shorts, get long those same stocks. Why? The Fed was really close to the end of the hiking cycle. They were only going to hike a couple more times. We're bullish. What I'm a little worried about is we're kind of close to the end of the accommodation cycle. And like, how much more are they going to really cut until you're like, whoa, they're cutting because things actually got worse, not, so I'm a little bit worried that eventually people won't be like, the cut's awesome. It'll be like, oh man, things actually did erode at a rate that's surprisingly bad.
He made it really clear that unemployment's the only number that matters now.
Full employment, yeah.
So we're at 4.1%. My friend Nick Colas pointed out in his note this morning, that is a lower unemployment rate than 84% of all the time that we've been keeping this data.
Right.
So it's a historically low, it's not at the low, but it's a historically low unemployment rate.
Right.
And the Fed is only looking at unemployment at this point, and that is not changing.
Then they're not going to cut, right? Yeah.
Thanks to immigration, we have a smaller labor pool, and that's political. That's by design on the political side. And everyone's got those fresh memories of in their mind of when they had to hoard employees 3 years ago.
Right.
So unless there's some massive AI breakthrough where the Fortune 500 can let go of 10% of their staff and not lose anything at all in the process, which maybe is coming in 3 years. I don't know. Right. Like what? I don't really see what changes the equilibrium.
Yeah, we do a lot of work on that topic and productivity because, it really impacts stocks and how people perceive stocks and margins. And then actually at Trivariate, we do a ton of work, on that same front. And I think more companies are apt to grow the revenue without net hiring than they are to do a ton of wholesale firing. I think it'll really depend, and it depends on the business. Sometimes you have to run things in parallel before you can fire people. So I don't think it'll be a 2026 or 2027 issue where you see massive firing as things are good.
Yeah,
I think there'll be businesses that could say, you know what, we can
less hiring.
Yeah, we can go 3% a year and maybe do no net hiring.
So do you think the stock market was rallying? Was the stock market rallying in anticipation of the Fed cutting? Like, it seems to not be bothered by it.
I didn't. You're asking a feel question, and I'm kind of more like a quant nerd about it. But I'd say my feel to your question would be, I felt like the market was reacting more toward, this concern that the Fed wasn't going to be independent or Trump could, fire Powell, and then when he wasn't, like that reaction than it was maybe about the actual cuts or not.
But that was like intraday.
Do you know what I mean? Yeah, there was like big moves around like, oh my God.
He's not really going to fire him. He's going to jail him.
Yeah.
It just occurred to me, we didn't give you your intro. You're a 3 or 4 time guest
It's
here.
my 4th time.
Guys,
almost 2% of your shows.
I know.
I'm pretty proud of that.
Adam is the founder and CEO of Trivariate Research. For those who are not aware, Trivariate Research is a U.S. equity-focused boutique research platform. Adam was the chief U.S. equity strategist at Morgan Stanley from 2010 to 2017. Of course, you see him on all the shows that I'm on. Closing Bell, CNBC, Halftime Report. You've done Squawk. You've been everywhere.
You missed that job?
So I apologize for missing you.
No, I love that. And if I could just do one plug,
Please,
about 3 months ago, since we were last on, we started a business selling to financial advisors and individuals.
All right.
Insights. It's called Trivector. We got some nice new stickers on the phone here. And so that's like $100 a month service. It's been awesome. We do ETF analysis. We give a lot of advice to advisors and people like why they should still, should stay fully invested, and how do they dollar cost average new business, and, how do they think about leverage and things that they ask me. And then we do, sector and industry ideas and recommendations, and how should they react to news. And this ETF analyzer we're doing is pretty cool. We give it like letter grades, like Portnoy sort of pizza reviews. So people seem to like that because, as you guys know, a lot of ETFs aren't exactly what the title
that's a great
is.
business.
So, yeah.
You know why that's great business? Because there are like 20,000 RIAs, and the vast majority of them just do not have it in their budget to have in-house research.
Yeah.
The CIO is the founder.
Right.
The portfolio manager is the founder's young adult son. They don't there's a lot of firms that need help.
And I'll tell you, you said there's 20,000. There's actually 400,000 individual advisors.
Come on.
There's probably,
I mean, like
there's
actual
probably
firms.
Well, actual compared to your standards, like 20. But I'm saying compared to like, so that's what you're saying exactly right. Because Trivariate, the institutional business, has every day for the biggest 3,000 equities, we download or compute hundreds of pieces of information. So we can kind of give them dashboards for data they don't have access to. And I do a monthly webcast where, I mean, you guys have these massively successful roadshows where people want to see you. And so for us, like people can dial in and ask me questions. And I'd say they like that. It's almost like they don't even want me to say anything. They just want to ask me like,
don't
what
give
do you
away
think of this
too
or
much
that?
though. For $100, don't give them
$100 a month. Yeah.
Don't give away too much. You'll never be able to raise the price.
Yeah, it's thanks, but it's been great, and we're in our fifth year now at Trivariate, and so it's good. Like we're investing in new opportunities and bolting on some stuff, and I'm working a ton, but loving it. So it's good. But thanks for this plug. I forgot about that because I just sat down and talked to you guys. I haven't seen you in a while. I'm happy to see you.
We usually don't get 22 minutes into the show before we.
I'm cool with that.
Guest.
I actually, it's funny. I forgot too. I was just enjoying being with you guys.
So Adam, how do you think about like?
And we'll play some golf now that you're doing that.
This might be too short term for you, but I'm just curious. So we have Microsoft up 4% today.
Yeah.
Meta is up 11%.
Yeah.
And the market is flat. RSP maybe looking like a double top. Who knows? Like, do you get caught up in like the short term nature of these moves, or are you like, dude, it's just a day? What are you talking about?
I try not to, but it's unavoidable. I'd like to answer your question this way, which is, I try to think about what new news changes my mind. And if you said to me like, look, Adam, you've got this optimistic view on equities, but what are you worried about? I can give you a couple of data points I'm worried about, and you just hit on one. One is ASML said when they reported that there were some tariff issues, okay? And I'll call ASML a very real company. They basically have a monopoly in a key portion of producing semiconductors, okay? So they missed a couple quarters ago. Everyone thought it's China, it's Samsung. It was kind of idiosyncratic. But Taiwan Semi reported the same day ASML did, beat and raised, made a tariff comment, but nobody noticed. The correlation between semis and the market are so high that I'm really focused on other semi companies talking about tariff stuff because I just think that the market, you mentioned when we were chatting, maybe the market acted great when UNH did it, but the market won't act great if semis don't. Okay, and so I got to sort of understand the contagion on tariffs. The second point is your question you asked me, which is, I thought the banks had great earnings, provisioned less, good trading, like multiple business areas, and the stocks didn't go up very much. And you always hate it when there's like a beat that doesn't go up very much.
They had gone up a lot.
They had up prior, totally.
Yeah.
But the best thing is when they miss and it doesn't go down, and you're like, all right, it's a cyclical with an all clear signal. So on that opposite logic, so I'm a little bit worried about your question of like, I would have thought the market would be up a little bit more today with when I was sitting there last night going like, whoa, look at Microsoft and Meta's numbers and look at eBay's numbers. And like, this is like, on like Donkey Kong. And like the market didn't, I thought we're up 1% on the S&P, 1.5%. That's what I'm saying. If you asked me at 5:30 p.m. last night, I thought we were going to be up big today.
Same.
So I'm a little bit, sensitive to the fact that we're like going to digest the good news. Or
what's great for Microsoft and Meta doesn't necessarily translate to the next 98 companies in the NASDAQ 100.
Now, on the other hand, we've gone straight up since the April lows.
Right.
You get back 5%, 7%, whatever. Kind of who cares?
I just think that what's been really hard for most institutional investors who are benchmarked against the S&P is that since the president said it's time to buy stocks, which was probably the best quant signal of the year, President said,
when was that?
April 9th at 10 a.m. or whatever. I mean, he said it's a good time. He was right. What's worked has really been low quality, what we call like hyper growth junk stocks. So, most institutional investors, they raise money from serious people. And so they have to kind of say, I buy top half quality businesses. They've lagged. And so I've been sort of thinking at some point, maybe good fundamentals would result in a bit of rotation out of, I don't know what you call your junk proxy. A lot of people would say ARC.
We call it the DGen
No,
Dow.
it's non-profitable.
Non-profitable. Goldman's losing list.
Yeah.
ARC, which is like a hypergrowth junk kind of asset.
We made a Dow Jones out of the most degenerate stocks, just not ETFs and not crypto. Just
and it was ripping.
And I think Sean knows the number, but it absolutely has
dominated
crushed.
in Q2. It dominated. So that's hard because you want to like participate when things are on. Usually the junk stocks work when you're close to the bottom of a recession and you expect a recovery in margins and earnings, or you think there's going to be a lot of fiscal stimulus or monetary policy that juices that. What's unusual, we had it, and we saw that around the election. Great red sweep, regulatory release, M&A. So you saw it last November and December. It kind of made sense. Okay, there's a bit of a risk-on rally. Small caps worked for a couple of weeks around the election too. But then for it to work in April when people generally think the economy is decent but slowly eroding, and we don't think there's going to be a massive fiscal stimulus because that's kind of anti-doji or whatever. We're already running at a wartime deficit anyway. It's just a little bit unusual to bet on a 4-month period like we've had of the junk running. So I think that's been harder.
This is a good segue into the conversation we're about to have with earnings last night. What we have on screen is the Mag 7 names since the low.
Yeah.
Chartkin Matt knew that Adam was going to be on, and he had to step up his game, and he did. So the best
Elite.
Absolutely.
Yeah.
The best performing stock since the bottom is Broadcom, which I know is not in the Mag 7,
Right.
but it's Broadcom, Nvidia, and then there's a gigantic gap. Apple's at the bottom. Meta, Microsoft are 2 and 3, and then Tesla, Amazon, Google are sort of in the middle.
Yeah.
But look at those returns: 91% for Broadcom, 88%.
The point being, there was no need to gorge yourself on junk because look at the returns you got with the AI trade.
No,
Microsoft,
You know what I mean?
it's a $4 trillion market cap.
No, totally. And I mean, anecdotally, I sort of think Broadcom is even more crowded than NVIDIA, just because I feel like everyone's there, and Hock Tan's done a great job, and he's on Meta's board. He's kind of like moved himself into the inner circle.
What does the quant stuff that you look at say in terms of crowded trades?
So
What was the chart on the right of that?
It was just a bar chart.
Oh, okay.
Yeah, I feel like the word crowding is kind of a weird word. Like we used to think of it 10 years ago as like we don't want crowding.
Now you want crowding.
I think
Depending on the market cap.
I think I did a dinner with 8 chief risk officers of big funds this past week, and a legitimate huge fund said that they now have a strategy where they get long the meme stocks. So they see Open Door, they see Kohl's. It's got a lot more options activity, a lot of short interest, a lot more options than equity activity. It's got a lot of short interest, and they see it squeeze from 50 to $1. They buy it from $1 to $2.
So
like you're seeing behavior that's totally different because they can measure that and make money on it.
So the earlier point that you were making that it's weird to see the low quality junk stocks rallying.
Yeah, people they just reacted to it.
So what if I tell you those stocks are not economically sensitive? They're not borrowers. In a prior era, junk stocks had a lot of debt.
Yeah.
These days they could sell equity. All they have to do is make some shit up about we're inventing a flying carpet. So that's one. Two, I don't think they're
access to the capital markets isn't the issue. I get that.
So I don't think they're economically sensitive. I think they're demographically sensitive. And the demographics, meaning the young investors, that's on their side. It's a flood tide of 27-year-olds with lots of money who want to have fun.
Yeah.
I think it's nothing economically sensitive about the way those stocks
I agree.
trade.
These guys are just, it used to be a couple years ago when the first meme stuff came out, with GameStop or whatever, that people said, all right, what are do we sweep X? Do we look for words? Like, what are the household name stores that the 27-year-olds will try to squeeze up higher? But when you look at Kohl's, I think people have been shorted for years. It's basically going to be pickleball courts at some point. The whole thing makes no sense. And it's gone from 60 to 7 or 8. And so people were just happy to be short this melting ice cube forever. And then it gets squeezed to 14 in 1 minute.
I'm surprised that they didn't learn anything, though, from 3 years ago.
Yeah, are your clients still doing this?
Why would you be short Kohl's down 95% from its high with 35% short interest in the stock?
When we ran our hedge fund, we really didn't short any stock that traded below $10 a share. It's just
it's dangerous.
You short a 5. So the Open Door thing to me is crazy. It was 50 cents and you were shorted. Like, what are you doing? Like, I mean,
right? Why are we shorting 50 cent stocks?
It goes up 5 cents. It's 10%. I mean, whatever. Like, that's just insane. But I think the point is just that the retail investor is a little less sensitive to valuation.
A little.
No, it's irrelevant. It's not even in the conversation.
It's not in the conversation. I did this several years ago. I had this guy, Igor Tolshinsky, who runs World Quant at a conference. And he did this whole thing, talents everywhere. We have 2 million, we're creating millions of signals a year. And it was like 250 people in a room when I was a strategist at Morgan Stanley. So I said, hey, just give us one of the 2 million signals, man. Like help a brother out. Give us one signal. And he goes, low price. And everyone laughed.
Right.
And I went back to the office and I met with the team and I said, this was like hiding a point. This guy's not friggin' kidding.
Yeah.
Okay, you go to certain countries. At that time I said it's Vietnam and other areas. People just buy $3 stocks. They think they're cheaper than 8. Then we studied splits in America and they generate subsequent return. You could divide a numerator and denominator by 3. Why does it generate subsequent return? Because people think it's a better deal when it's lower. They don't even know about the denominator, even here in the US. Even
so
some retail
stupid,
investors.
it's genius.
Right. Okay, so this guy was in our face in front of 250 of the smartest quants, every firm, and he's like low price. And so, and so I think that's an important issue. The other thing is a lot of money now is being run valuation neutral on purpose. So I don't know if you guys talk to like folks who run quant money, but it's kind of important for people to hear this. So take any of the big multi-strats. They're just 15 or 20 of them. People know the names, okay? And I don't want to, single anyone out because they're all clients of Trivariate, but a lot of them have like 35 quant teams. Quant team can be 1 to 5 guys.
Like separate pods doing different quantitative
right.
things.
And they run $50 to $150 million each. You may be like 50, 150 million. That's nothing. Okay, calm down. There's 35 teams. They run 6 to 1,200 gross. Now it's a $20 billion quant business. Does that sound bigger to you? All right, now here's the part that's crazy. Each one of these teams has hundreds of longs and hundreds of shorts. They run market sector and valuation momentum neutral, and they have a 3-hour to 2-day holding period. Their long dated strategy is 10 days. They turn over 10% of the day. So you want to know like why you bought a stock like Microsoft. It was up a lot in the aftermarket, and then it faded afterward because the only thing these quant guys don't do is play during earnings. It ruins the alpha of their algo. As soon as his earnings is over and there's a lot of liquidity there, they're going to grab that with something else. So you see a lot of guys short stocks that miss and they're happy, and then it goes up the next 5 days. Or their longest stock it beats and it goes down. A lot of that's just there's 15 firms that are doing what I just described to you. So everyone thinks like nobody cares about valuation. It's like they don't care about valuation because they're long, crazy, expensive stocks and short, crazy, expensive stocks on purpose.
And they wash.
Yeah, they're valuation neutral. So some of that stuff, the impact that has in the market when there's 10 firms with $20 billion on balance sheet with 3-hour to 2-day holding period is massive. And you're like a long only guy, you're doing real work and you're holding stocks for 3 years. Why is my stock going down? Why is it going down? Because everybody who's trading it today does not care about what you care about.
Yeah.
That's opportunity.
Yeah, and so durations on
they're
your side.
focused on 2 days.
Yeah.
So if you're focused on 5 days and you can like make it through the next 2 days.
But if I told you your job and all these multi-strats have fundamental guys who they have to call the quarters. If I told you, look, you're going to cover a consumer book right now, 30 longs, 30 shorts. You're a smart guy. And I told you you're going to get paid if you get the quarters right. All you're going to care about is what's in the price, who's going to beat, who's not. And you have to be long, short, you're going to be neutralized. And then these guys make $20 million in 1 year.
You know what's so hard about that
that's
game?
why they're incentive to do it.
Michael makes this point all the time. If you were to do a sports betting strategy like that, at least you know the odds. So like if the Giants beat the Green Bay Packers, they were supposed to lose, right? They were getting 10 points. And not only did they not lose, but they win. Everyone knew what the expectations were going in. They're literally published on the internet.
So these guys get paid.
We don't know.
These guys get paid $20 million to figure out the odds before they report.
Right. I would argue that real long-term investors are really doing some kind of Monte Carlo. Like they're saying, well, what's in the price of this thing has a 10% chance of being successful. I think it's 40%.
Right.
And there'll be asymmetric upside. Like that's really what they're
guessing
doing.
the expectations of everyone
and they're playing
else.
a distribution game. But the guys calling the quarters, like they have to bet on upward
It's
revisions.
crazy. They're Vegas. They're basically handicapping the stock.
But they have the ability to do things in detail, talk to experts, go to court case. Like they're diving in at a level that somebody who's running $50 billion with 20 names or 40 names trying to be at this, they're not, right? So they're playing a different game.
But how do they know what's like expected? Is it just like
remember the whisper number back in the day?
Talk to every sell side analyst, talk to your peers to the buy side, go to idea dinners, hear what people are saying, go to sector specialist dinners, ask what they're saying, look at every natural language process.
Sounds
every
exhausting
word,
for a 2-day trade.
Yeah.
It is, but if you're running 100 million at 8 to 1,200 gross and you get it right.
Yeah, no, totally get it.
Stuff adds up.
The reaction to Microsoft. So let's just go here because I think this is put the table up. So we're looking at what do we think the reaction is by the close?
Well, it's a pretty big fade. It's on the lows of the day. It's up 3, but it's up 4%. It's still, all-time highs. It gapped up to 555 and it's now at 532.
This is on a stock that's 35 times 35 times forward PE. And based on this chart, what you can see is in Q1 of 2023, which is really not that long ago, it went into the earnings at 23.8 times. So it's a lot of turns higher on forward multiple, and it's still rallying.
So this is interesting.
Results.
This is from
the revenue was massive. I mean,
we'll talk about that in a sec. This is from Consensus Media. They do great work here.
I was just about to look up the revenue.
What stands out to me here is that they've beat on EPS the last X number. What is this? 10 quarters in a row? Whatever it is. Whatever it shows, it's beat every time. But the single day reaction, a lot of pretty deep red. Right? Like a lot of pretty deep red.
It can be, it can be. I think
that's the part that's hard. You don't know where the whisper number is.
And it's also, like you said, how much it's rallied first and
how much is it up before the
and
print?
It's not just what they reported, but what's the implied guidance? Did they change the full year guidance enough that people, we saw that a little bit yesterday where a company beat, like Carrier beat, but didn't raise the full year number. So people thought the implied number was low. Whatever, there's a lot of that. Then there's, what about the gross margin? Was there a mix issue? Some people focus just on the Azure growth or the AWS growth, so it's really hard sometimes to isolate. One of my friends said this to me years ago. It's a 19 variable problem, and like we have to isolate it to one so we can understand. Like, there's just too many variables to get right.
Last night, Gene Munster said, tonight is a breakout moment for AI. Meta and Microsoft. Meta and Microsoft just sent a message
Who
to
said that?
Gene Munster.
Okay.
Meta and Microsoft just sent a message to every company. There's gold in those hills.
I believe he meant Herman Munster.
I don't know who Gene Munster is. I apologize.
No, Gene is like one of the top technology analysts. They call Gene when Dan Ives is busy. Gene's good.
I just don't know who it is. What is Gene?
I'm shocked that you don't know this guy. He's been around forever.
Okay, I just don't know him. Yeah.
We'll connect you. Finally, somebody said something positive about AI.
Yeah,
Seriously, is important.
All right, so throw this Azure chart up, John.
So the guy's bullish on AI, and he's kind of saying we got what we on.
It was breakout moment just in terms of like it's another CapEx guide higher from Microsoft.
That's rewarded by
Meta. Yeah, and Meta reaffirmed and actually raised the lower bound.
The midpoint of the thing came up. Yeah.
So this looks fake. This is from Alex Morris. It's Microsoft's Azure revenue run rate.
Look at NVIDIA's revenue run rate. The chart looks the same.
Yeah, it's unbelievable.
Yeah.
It's unbelievable.
I put one in my note on. You emailed me, Josh. I put one on NVIDIA. It looks exactly the same.
This is
no wonder the stock's up.
Look at the consistency of this growth every single quarter for 7 years. You almost like you couldn't have a better business. And it's insanely profitable, by the way.
So listen to this. Speaking of profitability, this made me laugh. This was in the deck. Microsoft Cloud gross margin percentage decreased year over year to 68%, driven by the impact of scaling AI infrastructure. They're spending all this money, and the margins are still 68%.
Yeah.
How about 120 billion annualized CapEx run rate, which is almost 40% of revenue?
I'm not surprised. We used Azure out of the gate at Trivera to do storage and compute because they charge a little less for storage than AWS, and we don't use as much compute. So given what we do, but we ended up getting rid of them. I'll tell you why. It's how like in a casino you can't find like the exit door on purpose, like they don't want you to. So I forget what our bill was. This
no clocks, no windows.
Yeah, exactly. So maybe our bill at Trivera was $6-7 grand a month to do what we did. And then one month I get a bill, beep, 10 grand. So I just emailed like, hey, that seems on a percentage basis like a fairly chunky, increase. Is there any? Did we use more compute? Did we use more storage? And it took 3 months to get an answer back from these guys. And I'm like, look, I'm not going from 84 to like 120K annual run rate without an email. And so I found these two dudes who do my IT, these two guys. And I was telling this to a client. They're like, what's the ticker? I'm like, no, it's two guys from New Jersey.
Yeah,
Mo
and Lenny.
Yeah, exactly. It's two guys. Anyway, so, and they kind of got me my own service for way less money. So I got rid of them. I think that Azure just has pricing power. If people aren't paying attention, they just keep raising it on you. You don't notice.
I think one of the things.
That's why their margins are so high.
One of the things about Azure early on, like 10 years ago, 2015, at the dawn of the cloud computing era, there was a debate. Is Microsoft better positioned than Amazon or any other competitor, Google?
Right.
And the smart answer, which I didn't know, but somebody explained this to me, the smart answer is Microsoft because the world is filled with people who have earned IT credentials as Microsoft experts for the companies they work for. Right. So if you already are...
There's GitHub, there's LinkedIn, there's a lot in the career there that people use. I mean, we use it. We use it a lot. And I think
the IT professionals working at the Fortune 500,
they pull the revenue in.
They're Microsoft credentials. So that's what they're doing.
I'll give you one other data point. At the beginning of this year, Gartner, which is a big kind of IT services company, came out with the 10 technology trends for the next few years. So we thought, let's search every earnings call transcript, 400 tech companies, and let's look for any evidence of what these, and I'll keep it ambient intelligence, so your computer's off, it's monitored to you, disinformation security, so people send you bullshit and it has to flag it for your IT, polyfunctional robots, post-quantum cryptography, agentic AI, so agents, all these things. So we tagged the stocks and we kind of created baskets and we followed their returns and multiples, whatever. And one of my big sum reports, we wrote this in January of this year, was holy crap, like Microsoft's in a lot of these areas. Like Microsoft, it was in like 5 or 6 of the 9 areas. And so one of our main conclusion points was people might be slightly underestimating like the number of balls they have in the hopper in a number of these areas. So it's kind of funny you say that because I kind of feel like they've invested in a lot of different areas. I sort of feel that way about Google too, but we'll see.
100 million monthly active users on Copilot, 800 million monthly active users using different products within Microsoft that include AI.
I don't think the product is that awesome, but I think I'm a user too. It tries to predict what words I'm going to say.
Teams is the worst thing ever, which is completely irrelevant. So the big question now is the CapEx. Like that's the whole market is hanging on that. And Josh mentioned that they got it to over $100 billion. They're talking about $30 billion for fiscal Q1. And I mentioned that chart earlier looked fake. This sounds fake. I don't know what this number means, but here's a quote from the call. When you think about the full year comments I've made on CapEx, as well as a Q1 guidance of over $30 billion, here's the part. You first have to ground yourself in the fact that we have $368 billion of contracted backlog we need to deliver, not just across Azure, but across the breadth of the Microsoft cloud. I don't even know what that means. $368 billion in backlog. I mean, even if it's half of that.
Well, these businesses were high single digits CapEx of sales, and now they're going to be like 15%. So that math kind of checks out. That doesn't seem crazy to me.
Michael has a CapEx. Michael has a CapEx to revenue chart or a CapEx to headcount chart of all of the gigantic, and they're all spending this way. The only one that's not is Apple.
Right.
Apple's CapEx for this year is $11 billion.
So I guess the question kind of
back to your world are they living in?
Back to your crowded question too, right? So there's a lot to talk about, unpack here, right? Because a cynical person could say, look, like they're not going to get the return on this investment. The depreciation burden their COGS goes up because
I've never seen anybody talk over the mic. You got to talk into it.
I feel like it's in my way.
He was telling you a secret.
I feel like it's in my way. Sorry. Thanks for. I'm not as comfortable with this number one shit as you guys are. No. So the CapEx sales, the CapEx has like a 3 to 4 year useful life, right? So the problem is you depreciate that really quickly over your P&L, and so there could be a burden on your COGS. Your gross margins go down, and then your multiple goes down because that price to forward earnings you showed is really correlated to gross margins for most businesses. So the risk would be they don't get return on it, and depreciation is up, margins are down, and so that's definitely one of the biggest couple of big investment controversies. But I think it's a little bit like the crowded question. Like I think you may ultimately be proven to be right if you're bearish, the return isn't there, but you might not know the breadth of proof cases to the end of 2027 or 2028. And so
it's a long time to sit out.
You're saying it's 8:30, the main course is about to be served, and there's a massive party after with the most beautiful people in the world and like the hottest singers. But you want to leave now because like you want to like you're worried about your parking, like the exit, like how fast you're going to get onto the highway.
Check this out. Last thing I have in Microsoft.
Right? Like your parking spot at the stadium is
also from Alex Morris. All right, so R&D expense at Microsoft nearly tripled over the past decade, from $12 billion to $32 billion over the same period. But it declined by 150 basis points as a percentage of revenue. This is unbelievable.
That's productivity. It sounds like productivity.
Yeah,
it's unbelievable.
They came out saying they saved $500 million on something a couple weeks ago, right? And I don't know how to think about that because you can do some monkey business with the accounting. I don't want to take people deep in the depths of accounting, but like I remember years ago when I was a semiconductor analyst, I used to cover Intel and others. Intel would do this thing where they'd have a new technology, like a new wafer. And so they would first kind of have that in the depreciation. And then they'd say, when we're really close to doing it, we'll count it as R&D. Or they'd move dollars from R&D back to COGS. And so what happens is the gross margins go up even though the operating margins doesn't change, but the stock market reacted to changes in gross margins. So there's some fluid stuff around like, what you're investing in AI, whether you call it CapEx, whether you call it R&D. I wouldn't spaz about it. I think it's just that the net margins and the revenue have been good and the stock's up because of that chart you showed earlier.
Let's do Meta quickly, and then we have other stuff to get to.
Yeah, let's talk about cooler stuff than this.
So Meta said there are 8 billion people on Earth, and Meta said 3.4 billion of those people actively use either WhatsApp, Instagram, or Facebook on a daily basis.
Seems right.
There's never been a company in the history of the world that has had this percentage of humanity as a daily active user. The stock is now 27 times earnings.
Right.
Is that high enough? Given like how powerful this company's ability is to reach into everyone's minds and decide what we buy, where we go, how we shop, who we talk to, it's pretty scary. Here's a chart from Sharkid Matt. 43% of the world uses Meta every day. And that number, for context, was 26% of the world in 2018. So, and that was, I don't know, they had 1 billion users and people said, how do you get bigger than 1 billion? Well, this is how. Time.
Yeah, I think that it's hard to know like what the right multiple is. Like I'm taking your question. Sorry, I keep leaning over the thing.
No, it's
Put it
fine.
right in my face. I think it's hard to know what the right multiple is because if I said to you like, let's rank order these big companies about which ones we're sure are going to be around in 2040 or aren't going to be majorly eroding in 2040, I might put Meta higher up the list than some of the other companies on the list.
Yeah.
You know what I'm saying? Because you're not sure, like, you know, do the kids, are they going to use, is the next generation going to use it? You know,
They do. They're on Snap and TikTok, but they're on Instagram.
They do, but,
Yeah.
but you don't know about 2040, right? Like I didn't know that, you know, when I was a kid, sorry, I'm the one.
No,
wrecking
No,
the
it's
mic.
us.
It's
I'm
falling.
It's
making
us.
you
It's
look,
falling. It's
you
falling.
made me insecure about my face and the thing and all over it.
Yeah.
I'm not used to having large cylindrical
Thank you,
objects in
John.
my face, so I'm just trying to get it right. So you know, I think there may be some longer term logic to why it doesn't trade at quite as high a multiple as the other businesses. And I would argue like some of the other ones have, like we talked about Microsoft, they have like 9 or different things that could work out, right? Like I know LinkedIn, when people first saw the side of the deal, were like, whoa, they overpaid for LinkedIn. Well, now it's like, I see a data point, like LinkedIn says there's 38,000 more job openings this week than last week. And I'm like, oh, that's much more interesting than the jobs report that comes out the first Friday of every month.
LinkedIn
Or, you know,
is
like-
crushing it for them.
Actually, LinkedIn revenue for back to Microsoft was up 9%, but they said
Every quarter.
there's been a slowdown in hiring activity. So
Is that not more interesting to you than whatever the
little
BLS tells
kernel.
us in the Friday? Right. That's
Yes.
that's what I'm saying.
Yes.
Exactly.
All right, last thing from me on the Meta thing, and we can move off this, is, again, the CapEx.
I think 30 times seems right. I'll give a number.
John, chart on, please. So they have a chart showing their quarterly and year-to-date CapEx in the most recent quarter versus the prior year, and it's just unbelievable. I mean, and they were getting killed in 23 and 24 for losing all that money in Reality Labs and investing so much money. Last year was $15 billion year-to-date, and now they're 30.
to be
It's
fair,
full speed ahead.
half of that is hiring people,
What do you mean?
paying
No, no,
$1 billion
no.
salaries to.
I don't know if that's in here, but either way, it's wild. They are all the way in.
I think if you read Zuckerberg's letter, which he put out the day of earnings, he put out yesterday, it's basically like all these other companies that are doing AI, they envision it as a way to replace people, and we see it as a way to empower people, and that's why we're different. I think their vision is like they're going to standardize the whole world. They have 3.4 billion in their audience. We're going to get everyone standardized on our AI tools.
Do you have the Ray-Bans? Do you have the Meta
No.
Ray-Bans? I feel like you
Me?
would. I feel like you're the kind of guy who would have the Meta Ray-Bans.
No, I'm the opposite of that.
You're not an early technology adopter?
No, it's not that I'm not an early adopter. It's that particular kind of thing, walking into a room and having people feel like I'm filming them. That's like what I'm trying to avoid attention when I move these days. I would not be that person.
Interesting. You know, I think
If,
the market.
if you were at a
I don't
house,
have. I don't have my. I don't want.
if you were in a backyard barbecue with a whole bunch of people, you're friends with some of them you've never met before, and somebody walks into the backyard with fucking cameras on their sunglasses, how anxious are you to be in that person's line of sight throughout the course of that day? Because I am going in the house to watch TV.
Yeah, I don't really go to parties or have friends, so
Fair.
that's a
Fair point.
Weird,
I did know that.
It's a weird
but
application. Like the worst part of this show for me, and I thought about this for the first time ever, is at the end of the show you ask about like what TV shows I've watched, and then I feel like
we're
the
not gonna do
biggest
that this
loser
time.
of all
We're not
time.
gonna-
If you want to talk about like the books, I'm in. But like everyone's like, did you see this one? And I'm always like, I hate TV.
Now, what is a book? All right. You wrote.
I actually prepared this time to think. Now you won't ask me, of course.
I will ask you.
Shouldn't have mentioned it.
You wrote this week. You wrote a piece about why valuation doesn't work.
Yeah.
Was it last week?
No,
This week?
Sunday. Couple days ago,
Fantastic. It was so good.
Thanks.
And it's not. Look, value investors don't need to be piled on, and that's not what you were doing.
No.
I think you're trying to catalog the various reasons why it's been so difficult. I could answer it with one term. Just say cloud computing. And if I just say that and I show you a chart from 2015, that pretty much answers everything. But you, I thought, did this more thoughtfully than I would. What's the message about why valuation doesn't work for picking stocks anymore? And after we go through that, we'll diagnose whether or not some of those things will ever reverse.
Yeah. I mean, part of me thinks it's like I could teach a semester at school about that. Like to answer it in 30 seconds isn't easy, but I'll just say
We'll spot you 60 seconds.
60 seconds. I'll say it's because the market makes stocks cheaper stocks that get cheaper on average get cheaper for a reason, that the fundamentals are more likely to be impaired, and stocks that get more expensive on average.
Has that always been the case?
Less than it used to be. It used to be, listen, I'll answer it this way. I used to think like value investing made sense and growth investing was crazy. In like the late 90s, when I was forming my investment matrix, I'm like, all right, well, I know like how much of a discount should happen in recession. I know where demand and supply is and when they'll run out of ability to borrow money, and I'll just kind of dimension the value. And growth was like, I'm looking at my finger and there's something called a TAM. It's a total available market, and that guy doesn't know, whatever. And so it just made more sense to me. And now I'd say it's like the exact opposite. Like, if I show you every stock that trades about 10 times forward earnings in the mega large cap universe, there's not a single one in there. You'd be like, whoa, that's kind of surprising that American Airlines is cheap. Like, of course it's cheap. It's going to file for bankruptcy in the next 10 years or whatever. Like, the traditional autos. Did you know that General Motors traded at a low price? Like, there's nothing on that list. It's all cheap for a reason we understand. And so the value guys just gambling on some future improvement that they can't see and have no visibility on. Because if they could, we would see it too.
That sounds more speculative than betting that people will still want iPhones next year.
Yeah, than betting on AI working.
Yeah.
Like, so I was at this pitch for a public AI high fee fund from this billionaire investor who was raising money on JP Morgan's private wealth network. And I was like, I'm going to hate this. I want to like hear this pitch, and I'm going to like be so cynical. I'm going to like mumble about it when I walked out. And even with my negative pre-attitude, the guy crushed it.
How much should you give him?
So it's funny. It's funny. He said, the answer is 0 because, I'm a cynical guy, but I was with somebody. I'll answer the question. So what happened is it's like a high fee public, and you're buying NVIDIA and Broadcom and infrastructure. And by the way, it's all 50% since the guy raised them. So the person, Dog and Pony show said, hey, isn't this all obvious? And then he gave an answer. And I was like, this guy's money. He goes, yeah, this guy's got several $1 billion personally. And he goes,
is it Chamath?
He goes, I have made 120% of my net worth on things that everyone else told me was obvious, and then lost 20% on everything else everyone's ever told me about. And I was like, okay. So you bought some cloud computing 10 years ago. You're buying some AI stuff now, and you're trying to get me to sell it when there's 7 years left in the cycle. Well, come back to me. And, like I said to you, at the party, it's 8:30. There's a dinner and a band and a party till 2 a.m. and it's 8:30 p.m. You want me to leave? Yeah. Because it's at 27 times earnings on Meta. Great.
Show us these charts.
That's how I feel about it. Yeah.
Here's a price to forward earnings over time. So how does this figure in? This is part of the AI answer.
So I just think Costco is a poster child for a company where you get margin expansion, it gets a higher multiple. This thing is a low margin business, and the multiple got to over 50 times late last year on forward earnings. And the reason is because their net margins were going up, and people thought they'd do a better job of monetizing at the door and, all that kind of stuff. And I pointed it out because there are a lot of really low margin businesses in the market. I am recommending McKesson and Cardinal and Cencora, they're drug distributors. For people listening, if they knew what the revenue of McKesson was, if you guys knew, I'd be shocked. Okay, McKesson is $360 billion revenue company.
Oh my God.
In 1 year at 1% margin. They're a drug distributor, pass through. If they can somehow predict employee and customer behavior better and margins go to 1.5%, that's 50% earnings growth. It's going to trade at 25 to 30 times earnings. So there's a lot of these like tens of thousands of employees, tons of revenue, billions of dollars, low margin. And if AI enables them to predict behaviors better and margins go up a little, you'll see Cintas and Costco and Walmart and all these businesses. Yeah. So you want to, not one, but a valuation mean reverting guy is going to say, oh, well, this thing looks expensive. And all they're really doing is shorting companies that have potential for margin expansion and productivity. And so that's like a key to why I don't want to use valuation in like a 3-year window to pick winners from losers. Another thing would be, and I don't know if you're about to show another chart.
We have NVIDIA as the poster child of AI revenue beneficiaries.
So this looks like your Microsoft chart you showed. It looks fake. The right half of it looks fake. They got it up in May of 23.
It looks like a projection.
Right. It just looks like some idiot first grader dragged across an Excel.
Yeah, like in Silicon Valley.
It's exactly what you criticize an US for. Like, dude, did you just drag that across Excel? Like, put some cyclicality in. Like, what are you doing? Yeah. You're fired. Right. Right. So that's an obvious, everyone knows the revenue beneficiaries. We talked about that. I think the part that's tricky for people, and I don't know if you have another one, is just the impregnable businesses. So whether it's, aggregates or toilet paper or water or waste management or whatever, like those stocks can trend higher, not because things changed at all, their growth algo changed, but because in 2030, I know I'm still gonna have waste, I'm still gonna need water and toilet paper. And so the relative 2030 estimate achievability got better. And all you're doing if you short them on valuation or sell them is saying, you don't want to sell, but you're selling businesses that have a higher probability of being around than others, right? I showed another one. I think I picked Getty Images or something of like that looks really cheap versus history. Do you think that makes any sense to get long it because it's cheap? No, like you don't want to long companies that have a whole like tax accounting, or there's a bunch of software companies where like they're not going to exist, so they got cheaper for a reason. The reason is they're more likely to be disrupted.
All right,
So,
number two, the way quantitative money is managed. We'll go through all 6 reasons.
Yeah. So that's what I was talking about, the whole valuation neutral stuff with the 100. Yeah. So that they don't care. They're long and short the valuation.
All right.
Yeah.
3, we did this too. Retail investors are less valuation sensitive. We know that.
Yeah.
Okay.
Wait, hold on. I have a question. So cheap stocks, shitty companies. Let's call them shitty companies get cheap. They stay cheap. They get cheaper until they just die.
Right.
Does that mean that the market is more efficient now than it used to be? Because there used to be an overreaction to the downside.
I think it just means that the market has gotten more anticipatory. It used to be years ago, people would say, well, I want to buy the stock because it's already discounting at most of a recession. So even if we have a recession, it's already discounting it. Now, stocks that get cheap into a recession are still the worst during a recession. The market was right to take them down in an anticipatory fashion because the market knows they're most impaired. The market gets increasingly anticipatory. I think that's the answer to your question.
So maybe it makes sense that the biggest pots of money are talking about 3-day windows, because over the long term, everything's already in the price.
I think that valuation will work, and I want to avoid incredibly expensive stocks and incredibly cheap, like the top and bottom decile. But
Stay in the middle.
I think
80%.
in the middle, then I don't have to worry about valuation at all. I just find margins.
But it's all about margins.
Yeah,
right?
margins or accelerating revenue or other fundamentals.
Yeah.
So yeah, I think that makes sense. Yeah.
You point out that valuation has not worked for a long time.
Yeah.
Like this is not new.
No,
It's just getting worse. It seems
getting worse,
that it's getting more extreme.
right.
Okay. Behavior into a recession. Did we
I
just cover
mentioned
that?
Yeah, exactly.
All right. And then valuation being related to margins. I think that's like a really key point.
Yeah.
It feeds into my cloud computing shtick. It's like these are companies that used to have a computer room. Like if they wanted to expand, they would have to buy more servers from Dell and HP. They would have a cost that just isn't there anymore. It's a different type of cost.
Part of who we talk to are like these cross-asset guys, or usually like if I go out of the U.S. or I'll say people over a certain age, and I'm 56, so I'll say my age or older. They tend to sort of use like Grantham or Schiller PE or CAPE or like a valuation mean reverting framework. And they'll say, well, I want to be underweight U.S. equities. This is a TMT bubble like 2000. And I don't agree with that. When I push back on them, as I say, all you're saying is you think margins are going to get killed for U.S. equities. Because if I show you how much market cap has above 60% gross margin today versus history, I've shown you how many companies have high margins. All you're saying is that, that you think margins are going to get killed. So like, I like the example of like, do you think there's anything that's worth more money than anything else? Like, do you think the Four Seasons is worth more money than Motel 6? If they were both $40, which one would you choose?
Yeah.
Right? Like they're not going to trade at the same multiple because one is growing faster and has higher margin superior to the other.
So this is what they got wrong, the Bears. This is from Duality Research. And in 2017, 2018, when we were hitting, quote, peak profit margins, it was really difficult to foresee that the mega caps would continue to take market share, to expand their margins. It was impossible, but that's exactly what happened. We're still at all-time highs in the market because we have all-time highs in profit margins.
Yeah, the median stocks margins in the top 500 aren't all the way back at highs, but they're certainly up a lot, from where we were, 6-9 months ago. And the mega caps are high. So yeah, S&P, maybe on a dollar basis, that's true. But I look at even like the median stock, and I think the median stock probably has, I know CapEx is up for the big hyperscalers, but the median stock has lower CapEx year over year. Wage pressure is down year over year. I haven't seen a lot of companies, maybe we'll see it, like you said, in the illegal immigrant stuff with healthcare services or restaurants or roofers or home builders. But generally, we haven't seen companies talk about labor shortages at all yet. So I don't think wage pressure is there. Commodities, Bloomberg Commodity Index, they're kind of down. Currency is going to help a little bit. So, some companies have trouble with pricing, but a lot haven't so far. So like, I think the median company could probably have gross margin expansion in the next 6 months.
This is the funny thing about tariffs. Like even if that becomes a problem for companies, it's happening at profit margins that are starting at 14%. Like they'll figure it out.
Yeah, and also like it really, like I'm underweight staples and we're underweight discretionary. We have kind of a cautious view on staples because I think they're the most vulnerable. But 58% of the S&P is tech, comp, services, and financials. And on the margin, like they're not really going to be that impacted by tariffs, in terms of the bulk of the earnings. And we've seen that so far during this earnings season with who's reported generally in tech and financials, comp services. So sure, like, if you're a staple company and you kind of have no game and Walmart comes to you and says,
Yeah.
yo, eat it, you can decide like either you eat it or they put you on like shelf 912 on the back and they hurt your sales, right?
So it's always a trade.
That's
volume,
a trade-off.
volume
versus
or price.
But Walmart and Amazon are $1.5 trillion in revenue. So they got the wood, so you got to kind of, so I think it makes sense to be cautious on most of the staples and select this consumer stuff, but I don't know why I'm negative on JP Morgan or negative on, the tech companies that are exposing. It's funny, you were talking before about like the long-term growth rate. I was thinking about Palo Alto Networks and they announced a deal this week. And I remember thinking like, man, these cybersecurity things, this is like 5 years ago, like this is so obvious. Like, of course you need security in the stock.
It was the most obvious trade on earth.
Since then.
Yeah.
And by the way, like talk to any IT guy, it's like the last thing they'll cut. Like I told you,
you can't cut it.
I'm moving my office tomorrow and the guy came today to make sure the firewall on the thing that I'm starting tomorrow is like 100% good.
I think this is one of the layup trades even before AI.
Still.
Picture a board of directors at a publicly traded company taking a vote.
Right.
Let's reduce cyber spend next year by 10%. We have time for one more, and I really wanted to get to this because I think it's low-key one of the most fascinating things to be following going forward.
Right.
The Wall Street Journal did a really good, very data-heavy piece about AI already disrupting new college graduates. And my daughter's 19, so her friends' older siblings have all just graduated college in the last year or two. And every one of them wants to have a conversation with me for some reason, as if I know anything about how to get a job, how to do an interview, how to present myself on Zoom. I literally can't help anyone. That's
not true.
But I also will never say no to a young person who especially if
we have more interns than employees, but
especially if we know the family. So anyway, I'm doing meetings like that, and I'm trying my best.
Right.
But anecdotally, and I now have the data to back this up. Anecdotally, it really feels harder than ever, other than in a recession, to be coming out of a great school, BU, Tulane, Michigan.
Whoa.
Schools where people should get hired.
Whoa.
What?
I went to Michigan. Let's not lump that into some of the other places you mentioned.
People should, Tulane and comparable schools like Michigan.
Let's calm down with the Michigan-Tulane compromise.
It feels anecdotally, talking to parents, that kids coming out of school are having a tougher time than ever.
Yeah, totally.
And now we have the data to back this up. So I'll just show a couple charts.
Yeah.
So here's one.
Yeah.
Share of graduates in the labor force with a bachelor's degree 1 year after graduation. So this is just really showing like the big picture, the backdrop. And then here's some stuff from the piece. The unemployment rate over the last 12 months, ending in May, for recent U.S. college graduates, these are people between the ages of 21 and 24, is 6.6%. That's compared to 4% for the overall labor force.
I'm just Googling what is Burning Glass Institute, just because.
I made it up for the purpose of this conversation.
Okay, I just want to know.
50% drop in entry-level hires at major tech companies.
Right.
That's down by half since 2019.
Look, like ChatGPT.
It's really tough.
ChatGPT Deep Research 03 is like 10,000 interns. Okay, I'm like you on this front. We have a ton of interns because everyone's kid, niece, nephew, friend's kid. I just say yes. The truth is none of them are useful to me because all that we do is code in Python against our database, and it takes us time.
Are they faster than Uber Eats though?
Oh, right. No, but I don't want to do that stuff. So I try to give them a real project and have their name go on a piece of research and have them help. And so what we've been using them more for is spot checking some of the work we're doing with natural language processing or that kind of stuff where, for example, I mean, I'll give you 4 or 5 projects I'm working on with different interns, friends of mine's kids, whatever. One, we did a piece looking at activist investing. We published it this week. And I think you're on my distribution list. So we kind of looked at, the history, the distribution of returns on activists. So we had the person help us kind of really define who the correct activists were, remove some individual names that didn't make sense, that kind of stuff. We're doing a piece on variable compensation of management teams. That's really hard to do with natural language processing because it's not like it's on page 151 of the Bank of America, or, 10K of what the guy made. And, it's really complicated. So we're trying to do some kind of spot checking, reading, like trying to use them to do something that I can't do with NLP. Litigation, we're doing a big piece on lawsuits because there are a lot of stocks that look optically cheap. maybe they had a fire at PCG or Hawaii Electric, or maybe they did a PFAS at 3M, or maybe they did an opioid or whatever.
So you have the interns helping you with
us
an
spot,
AI.
Yeah, with natural language processing kind of output to sort of make sure it makes sense.
So are you guaranteeing them all full-time jobs when they finish school?
No, we
There's no way.
We don't.
You can't.
We just try to help my friends and relatives' kids have on their resume that they worked at my firm and that kind of stuff.
Here's the question. Last chart.
But your point's well taken. Like, you got to have differentiated skills. And for us, it's like coding or other stuff.
Pay attention to the slant higher under bachelor's degree in the fourth column. This is unemployment rates by educational attainment and age. People with a bachelor's degree in 2018, 2019, 3.8% unemployment. Now it's 4.9. That is a really big jump in a 6-year span of time.
Look at graduate degree, same thing.
And graduate degree is as steep a slope from then to now. And these numbers are not all of a sudden going to reverse.
I think that what I struck my eye immediately was where your mind was, which was the graduate degree at 4.2, 23 to 25 is the same as some college no degree in 18, 19. 4.2. That's a little bit. That's a little bit messed up, because you had to, if you stayed in college from 18, 19 to get your master's degree at 25, you got nowhere. That would be a rough 6 years. So yeah, I think.
What do you think is the trajectory of this?
I think it's because you have to get a degree in something that's useful. I mean, and look, I have friends that are very senior at big law firms, investment bankers. Everyone's having the same conversation. Like, how are we going to train people to be like our generation? Because if I can already get a 30-page brief written that's 70% accurate in 1 second for free, why did I pay a first year, a bunch of money, bill a client $500,000, and they write something that's 70% accurate, and it takes them a month, and I have to yell at them. Like, there's every profession, investment banking. Like, come on, what do? They take the pro forma P&L combined from two entities. Well, I can use ChatGPT, deep research, and do that.
The Gen Zs are gonna hate. They love AI now for their homework. They're gonna hate it. I'm really worried about this.
I think there'll be
the second half of the decade.
there'll be a new body of stuff that forms, and whether it'll be. I'll give you a great example in healthcare where we may have talked about this last time, but like, if healthcare, if you get better at like image recognition with AI models, let's say right now 6% of women are told they have breast cancer when they don't, because you got to have 0 type 1 error. You can't have anybody have cancer and tell them they don't, right? So somebody comes in, you tell them they have it.
There's more false positive. There's always false positive.
False positive, type 2 error, right? So what if it's 6% right now from the best radiologists in the world, and it goes to 0.01% with AI? But when it's 0.1%, somebody finds out you screwed me, type 2 with a machine, and there's a lawsuit. Like, there's no lawsuits at 6%, but there will be a 0.01 if it's not a human. So there'll be a whole body of new things that happen on checking and quality control and on legal and I think there'll be new jobs that form. There'll be,
like become an expert in the things that AI usually gets wrong.
Right, gets wrong, or there's going to be new stuff that happens.
What do you think about this?
I think there's a lot of possibility and I think you just hire less people to do the high paying jobs, and that they have. One last point is the S&P 500 is way different than the economy, and I think people like economists always like, oh yeah, this we don't want to see. We want CapEx to pick up, and whatever. So I just think the top 100 companies can be superior for sure.
I think that entry-level jobs are now superfluous, and it is a huge, huge issue. And
you agree with me? This is like not going to be great.
No, it's awful, because I think I saw something that only 10% of business respondents are using ChatGPT or any sort of AI system now. When it is more pervasive, when it's 20 and 50 and 70 and eventually everybody.
I think it's higher than that, but okay.
Whatever it is, you just don't need kids to be doing entry-level roles, which is catastrophic. Now, I also know that there's always this fear with new technology, and there's always new jobs created. So I'm
a little bit in that camp.
So I don't want to be hyperbolic.
Yeah, you're
eventually.
I would say like, look, you used to use, it's the Milton Friedman thing, right? Like, there used to be, used to use, shovels to dig ditches, and then you got like big machinery. And if it's a jobs program, you tell people to use spoons. Like, people they'll navigate towards some other skilled things, and there's a lot of stuff that's going to happen there. I mean, I think there's going to be AI software, there's going to be AI semiconductors, there's going to be power and infrastructure, there's going to be energy transition,
there'll be all sorts of new jobs, of course.
There's going to be life sciences, there's going to be tons of old people demanding tools and diagnostics and services and other stuff. So, look, I also get that there's a lot of really high paying professions that don't require an education, where I can get the knowledge for free. I mean, anytime I have some HVAC guy at my house, we got a new air conditioner in my kids' room today. I'm thinking the PhD and 30 years of experience got me shit on my HVAC guy who can just drill me with pricing, and I have zero elasticity of demand, right?
Yeah.
So, I mean, there's a lot of professions like that where, plumbing, that I think are going to be, so those impregnable
The moms in my town are all getting this content fed to them by the algorithm now on Instagram about like push your son and daughter toward like these types of professions.
My son goes to culinary school.
He'll be fine.
I'm kind of happy about that. People are going to eat. Yeah, people like eat. Yeah.
Until the robots come. All right, we could cap it there because this kid Max is going to throw himself out the window. Everything's gonna be fine. You'll be fine. I promise you.
This is the
all right.
longest he's.
You have fun on the show today, Adam?
Honestly,
you said it goes fast. Did it go fast today?
It goes crazy fast, and I'm sitting there thinking like, I wish I had in my life something like this I could do all the time. Like I'd come on once a month to be like.
Well, listen,
I love being with you guys. Great to see you.
We'll take you up on that
anytime. Honestly, it's easy for me, and I love being here.
All right, so we want to hear about all the books you're reading. Big brain. Let me hear.
No, I just not like I was kind of kidding. It's just that Are
you reading books still? Because Michael gave up, and so did I.
No,
I'm going to read one book by the time the summer's over.
I'm reading a book, and this guy will be psyched that I'm plugging this, and I didn't. It just literally was on my stack. It's called On Board. This guy Jonathan Foster runs a fund called Current Capital. Has been on a bunch of boards of companies, and he gave me his book. And obviously, because I'm a sucker, he references some of my work in the book. So,
okay.
But he's good. And actually, I'm looking at your shelf there, Barton Biggs on finance. I'm also in that book. So this is a good it's a good little moment for me. I know
Adam's in 13% of the books.
I've had 2% of your shows and about 9% of your books. So this is a great.
I love it here. I started listening to books, and I think I could do it. I think it's going to stick.
It's funny you say that. I've learned. I didn't know this about myself till 2 years ago. But maybe this is like bad thing to say, but like I just don't remember stuff when I hear it. Like,
sure.
Maybe my wife.
My mind drifts.
Yeah,
listening
and so
to a book.
I listen to podcasts, and then afterward, I'm like, my wife's like, we listened to that in the car when we were driving together. I'm like, I wasn't there.
I drift sometimes.
She's like, no, you literally we were talking about it. I'm like, I don't remember.
Yeah,
if I read it and I see the chart, I remember it forever. If we play golf, I will remember all 18 holes, the right, the left. I'm like a visual guy, and if you tell me like the name of the guy we played with, I will not remember.
But that happens to me when I read a book too. I'll read a 400-page book, and a week later, I'm like, wait, I don't remember anything.
See, I'm just more visual that way. So I just prefer to read it. And I think it's also, I'm still like, I guess I'm like in the generational gap of like, I physically hold the book.
No, totally. It feels weird to say that I'm an audiobook guy now, but I'm no shame. I am.
No, you're in the majority. I'm wrong. Yeah. You're right. I don't enjoy, I just also for some reason don't have a lot of time in my life. My wife's got me on this guy, Jay Bernstein's podcast, and I will listen to it. He has this thing where people talk for 6 minutes, and I walk to work, and it's like a 15-minute walk. So I can actually tolerate the 6 minutes. He's got some very interesting guests on, but I just not, other than Compounded Friends, I'm just not a regular,
I think I've got my AirPods on 3 hours a day, honestly.
Yeah. Oh, really?
Just
I read a physical book. I finished it yesterday. Very proud of myself.
What does the word physical mean?
I don't read nonfiction anymore. I only read novels. Because I'm a writer.
I'm the exact opposite. I only read nonfiction.
I want to improve my writing, and I don't think you can do that unless you read good writing. So I read our friend Gary Steingart is out with a new book.
Okay.
Gary's one of my favorite authors ever, probably my favorite novelist right now. Give him a So Gary wrote Super Sad True Love Story, which was a smash hit in the 2000s decade. And he's had some huge hit books. And the new one is really short. I read the large print edition, and it's only like 200 pages. It's a perfect summer novel. And when you get to the last 2 chapters, like your heart breaks in half. Okay. It's like, this is the thing that only novels can do, and you don't get from reading
I like this side.
nonfiction.
I love this side of you. This is a very nice side of you.
Lake Success did that for me.
Yeah, this book will completely break you when you get to the last. But it ends in a decent place. But it's this is the only books that I am gonna give time to, is like things that are evocative and bring emotions out. It's an experience.
I love it. I love where your head is right
now. It's called Vera or Faith for people that are like, what's the book? Really, really great summer book. So
I have a stack on my bedside. I just try to kind of put them in, and read them as people recommend them. So, but 98% nonfiction. But I should be better. I like where your head is. What about you? What are you, Mike?
I'm listening to The Godfather.
Oh, the original.
It's incredible.
Mario
I mean,
Puzo. Okay. Yeah.
Breaking news. It's good.
Yeah. I like it. Hey, many years ago, might have been 2000.
You in the mafia?
There was like a top books of the last century or whatever, and I like got them all, and I was like committed to 20, and I plowed through like 12 or 13 of them, but I couldn't make it all through because some of them were like 1,000 pages or whatever. But it was like forced me to read like the oldies but goodies. It's smart. It's good. I like this. Don't you feel like this has been a good ending as opposed to like I watched what's the TV show? Like,
yeah, it's amazing.
Neighbors and Friends.
Michael listened to a book based on a movie, so we got that going for us.
And you're reading some.
And I read large print edition of a 200-page book.
And I'm reading about this guy who was like on the board of a bunch of companies. He's actually very interesting, taught me a bunch of things. So, but I'm like, if it's not stocks or sports, I'm kind of out.
I got it. I'm trying to broaden my horizons.
Can't say yes to
Yeah.
everything.
Yeah. Well, it's a pleasure. Thanks for having me.
Yeah, thanks.
And if anyone, if I can do the 30-second plug, just
please do
go
it.
to trivectorresearch.com.
Oh, I was sending people
Check
there.
it
Let's
out.
give them the URL though.
Yeah, we'll give them the URL.
Okay.
www.trivectorresearch.com. And if you say you're Compound and Friends fan, we'll give you a month
Look
free
at that.
just to check it out.
Look at that. All right, ladies and gentlemen, this has been Adam Parker.
Great to see everyone.
Follow Adam on LinkedIn, where he's active,
Yeah.
and please check out Trivector and Trivariate, his research products. Great job on the show this week, guys. Great job on all the shows. Thank you so much to the entire
This is an amazing crew.
Compound crew.
Amazing experience. Thank you.
Continue to crush it. All right, guys, thanks for listening. We'll see you soon.
Welcome